Good afternoon, everybody. It is Monday, 4 o'clock, and we are doing our multi-pack webinars today. A year ago, I wrote an article that talked about the younger investors in the market. And I asked, will the young traders flip the option switch to cause a crash? And I talked about in this article how the millennials were using call options to push stocks up. A lot of activity, a lot of call options. And I asked, could they start to buy puts when they wanted to push it in the other direction? For example, let's suppose it got difficult to push the stock market up because of talk of tapering or a black swan such as China, or whatever reason, valuations just got too high, or Congress is flirting with the debt ceiling, or we're not going to get as big of a fiscal stimulus as was proposed 6 months ago, or pick your or all of those things happening at once. So the millennials started to buy some put options in the last few months, and are now at kind of the center of their range, just kind of high put option activity, this kind of low put option activity. That's a swing of over 5%. So let's suppose it gets back up to here again. What would be going on? Well, this was the crash, coronavirus crash. Is it possible that they just keep piling on puts week after week after week until stock market is down, say 15, 20, 30%? Well, let's think about this. This is the big money. Big money has been closing their put options, although the big money also uses the futures market. And I'll tell you, the futures market is not very bullish. It's pretty bearish. But the big money, the hedge funds in particular, just kept getting burned by these millennials who are building websites to tell each other and using Reddit to find spots to blow up the hedge funds. Why? Because they've decided the hedge funds are evil and they cheat and that they manipulate. So the millennials responded by saying, hey, well, if you're going to cheat and manipulate, then we're going to do it too, but we're Robin Hood, haha. It's really kind of ironic. So the very ends justifies the means. And think about that generation with that attitude. It's a gigantic generation with an ends justifies the means ethic. That's dangerous. And we'll see how it turns out. But if you are a psychological economist, as a behavioral finance type of person, becoming very apparent to us that millennials are nothing like the boomers when it comes to how they handle their money. The boomers have been very emotional from their teen years all the way to their retirement years. It's never changed. I see it in the boomers that raised me, the whole generation of them, all the way across the board. The emotionality of the boomers is pretty intense. We've all experienced it. Can't deny it. If you do, you're lying. And it's manifested itself in the stock market. And there's this idea that the millennials are going to get burned the same way the boomers have gotten burned so many times. But the boomers, for all the talk of saving the world and peace, love, and happiness and sex, drugs, and rock and roll, they never fixed it. The world just kept getting better because that's what the world does until we blow it up, cause a disease, whatever. In general, the world's been getting better. There's fewer wars, less people dying in conflicts, less hunger, more education, better communication. Communication ultimately should be our savior unless we let it destroy us, because none of us really know how to talk to each other anymore. That's why I always recommend a book called Beyond Reason. I just sent that book to my brother for a little communication help I could give him. Beyond Reason, it's written by a professor that helped with the Camp David Accords. And I was given that book in some executive training that I went to Lake Tahoe for 6, 7, 8 years ago now. That's where I met some pretty big shot people. And I realized if you can understand people's basic psychological needs, which are everybody wants to feel like they're affiliated with something. They want to have a role in that thing that they're affiliated with, and ultimately some status, but they want to maintain their autonomy while being appreciated. Those 5 things: appreciation, autonomy, status, role, affiliation. Those 5 things drive everybody's psychology. And there's different ways of breaking it up. But ultimately, if you can appeal to those qualities for people, you can create win-win situations. Because pitching a win-lose situation is tough. Then you're just trying to defraud somebody. But if you can create a win-win situation, it goes a long way to helping the world continue to get better. That is the eternal fight, is the charlatans versus the people who are trying to make things better for more people, including themselves. The difference between trying to get a slice of the pie and helping make a bigger pie. So when people talk about, oh, well, he's just a businessman, that's a euphemism for he just makes sure he gets his slice. And there's other people out there who talk about starting companies that do multiple things and enrich the investors, save the environment, get involved with the new financial system, and provide housing, sustainable housing. Those people are trying to make the pie bigger, not just get their slice. And make no doubt about it, those people are also trying to get their slice, but of a bigger pie, and really their slice gets paid for by the fact that it's a bigger pie. So when you take a look at the millennials and the war that they're waging with the hedge funds, it really is an interesting study in human psychology. The amount of brainwashing that goes into it, the amount of results-based analysis, meaning that they only analyze things after they see the results, the opposite of science. Science says, here's my problem. Let's do a whole bunch of experiments and see where it leads us. Results-based says, well, let's take a look at the end result, then we'll make up the problem that it solved. And we'll fit the evidence into what we want it to apply to. We may never even get to the original question because we don't need it, because we'll get to the point where it's enough to justify what we want to believe. But when you consider the fact that the millennials are taking over the stock market, which is clearly what is going on, there's no doubt about it, you should be aware that they have a different mindset than boomers ever had. I'm not entirely sure which fork in the road, and I use the word fork because of cryptocurrencies, just I think that it kind of fits, where the forks will be for the millennials. I'm not really sure. But in reading Reddit and tracking a lot of data on social media, it is apparent to me that the millennials are taking no prisoners and offering no quarter to those that they choose to go to war with in the markets. You don't want to be against them. You don't have to bet with them, but I'll tell you what, you don't want to bet against them because they concentrate their money as a group using social media and other platforms in the internet to completely overpower whoever it is they're fighting against financially. What was that phrase? Shock and awe, overwhelming strength. These are military terms. So when the millennials decide they want to push something up or they want to push something down, either get on their side or get out of the way, depending on how good of a bet you think it is. So I talked about some different stocks. I just focused on Microsoft because last week we took a look at Apple. Microsoft's about $5 off of its high, right? It's not a big dip. It's resistance line that becomes support. So price, man, it's been so long since we even thought we might be able to get a chance to buy this. We haven't updated it. If Microsoft gets down to, what is that, 240-ish, 250s? Doesn't matter. It gets down in here, you probably have to buy it. If it somehow gets to this area, which is going to look just like the QQQ chart, you got to back up the truck. We put QQQ over it, you see the similarities in the charts, right? So same thing in either case. If you're looking at buying at Microsoft, those are your prices you want to get at. If you're looking at buying QQQ, which is probably what I'll do, then it's here and here. So around 300 on QQQ is you really got to get a position. And if it somehow goes all the way down to the 250s, you know, start selling children and stuff to buy the stock. If it gets down in here, something really wrong is going on in the world. We take a look at some of our growth stocks, and I put Ametis in here, and somebody mentioned in the chat room at Fundamental Trends that they found some weird research report from a knucklehead. I did a 5-minute search, and I realized, oh, this is the same dumbass who was telling me how bad Exact Sciences was 10 years ago and some other stocks. And the guy's name is Jacob Ma Weaver, and he's a literal piece of shit. He's a guy who washed out of a job at a pension company because they didn't like his ethics. And I know this because I asked somebody that I knew that knew people there. And this guy is now a hit and run short artist. And he's changed the name of his company several times to do it. I'd love for him to sue me if he ever finds this video. Hey, Jake, kiss my ass. Those shorts that you had, especially in Exact, made me a lot of money when I told everybody that you and Citron were full of shit. So let's take a look at Ametis, which is a stock that you're going to need to own. Spiked on hopium. Now it's come down. And in the last month, a lot of good things have happened for the company. Well, that video that I was playing beforehand as the intro, something you should watch so that you can understand what these guys are doing. If this stock comes back down to 11-ish, that's your golden ticket to get back in. Because it got up to here, which is higher than the previous high, you're probably seeing a breakout getting ready. Super volatile. When you understand what they do, you'll start to figure it out. Essentially, what these guys are doing is taking carbon from dairy farms, right? You hear me talk about cow farts all the time. They have to save the world other than not eating meat, as far as I'm concerned, because I like my burgers. And I like my pork shoulder, other meat. I don't really eat it every day anymore, but the point is these animals that we use for food and dairy produce a lot of methane, right? A lot of carbon that they put back into the atmosphere. Because the cycle is they eat the grass, which has been capturing carbon, and then they fart and poop it out. That's how it works. Well, these guys, like another company that I've told you about a number of times, are capturing that and turning it into fuel so that we don't have to use gas and oil. So that carbon, it's already going into the atmosphere because the cow fart, now can just be turned into fuel so that we don't have to release other carbon. It ends up being an almost net neutral trade. What other company do we know that's doing something like that? Again, New Light Technologies. Look what is on the front of their presentation page about their technology. Cows. Because in agriculture, you can capture all sorts of CO2 and methane. You can turn it into other things. These guys aren't turning it into fuel. They're turning it into plastic. They got a major private equity investment from a company in petrochemicals. Why? Because the petrochemical people see it on the horizon. They know that they're in the end game. It's a long end game, but they know that they're in the end game because technology is going to make fossil fuels just a lot less necessary in this decade. And I would love to get into New Light Technologies, but they're private. So I've told everybody, if you see a backdoor way to get into this company, you let me know. So I haven't been able to find it, and I've been looking for years. Years I've been trying to get into this stock. It's not a stock yet, that's why. I've been hoping that somebody in the SPAC space would cut a deal with these guys. If any SPAC cuts a deal with this, we want to buy it immediately before the crowd. Midas has been around a while, 2006. That Jacob Ma Weaver report says that they were brought public by a reverse merger, which may have been the case in 2006. I don't even know. But he was trying to call it a SPAC with a problem from like last year. He was bending the truth a little bit to have a sensationalistic opening to the article, knowing that people aren't going to get to page 15. Just throw out all the accusations on the front end, big and loud, like a politician. Meanwhile, these guys are collecting tax credits and tax incentives. They're already selling jet fuel. They've got a pipeline deal now approved to business with utilities. Not a fake company. Jump on over to AST Space Mobile, and I'm going to use this as a way to help you understand that the millennials control the market now. Here's a stock that spiked on hopium, right? Does this not look just like the Gartner hype cycle, that chart? You all know what that is, sort of, kind of. So let's take a look at the Gartner hype cycle. Right, here's the Gartner hype cycle. There you go. And looks kind of like that, doesn't it? Pretty interesting. Now, the weird thing about AST Space Mobile is we're not 100% sure that it's going to work. But if it does, $100 stock. Who really likes this stock? Turns out, millennials really like this stock. It is the third most talked about stock. There you go. Internet mentions, stock talk, message boards trends. This is one of the most talked about stocks in the millennial social media, Twitter, Reddit-verse. And they understand that this is a stock that with a very small bet can make you a lot of money. And because it's a small bet, it's asymmetric with its potential upside. This is why I say the millennials are being very tactical. They are picking out stocks that can go up a lot without a lot of downside. Now, it's weird to me that they're hyping up GameStop and AMC. I mean, those at this point they're just trying to destroy hedge funds for the sake of destroying hedge funds, because GameStop, which I'm intimately familiar with, having written a thesis on it 3 years ago, that is exactly what they're doing now. Even in delivering on that thesis, it's not a $300 stock, maybe 100. But remember, it was down to like 5. So from 5 to 100 is pretty good. Problem is, you got a lot of people buying it at, up here. Or they bought it at 200 or 250, and someday they're going to lose money. AMC, I'm very familiar with because of our EPR. I don't see the theaters coming back in a big way for at least another year. And they can say all they want about their new revenue numbers and people going to the theater. I'm going to go by what I've seen. Because I've been going to theaters and looking at theaters and trying to figure out if there's really as much business going through those theaters as there was 2 years ago. And except for isolated spots, it's just not happening. I mean, where I live, there's about 10 theaters within 10 miles. One of them does big business. One. There's only one that's caught up. All the other ones are still struggling. I can literally go and rent out 3 rows so that nobody's near me if I want to, but I don't have to, because the rows literally have 2 people or 4 people or 5 people in them. So I don't really understand. Again, going back to that earlier psychology thing about the millennials, I don't understand all of it. The AMC and GameStop are 2 things that I wouldn't buy because I know they're worth a lot less. And I think the whole stonk hodler thing with those stocks is almost over with. I think they're running out of juice. That's what I think. And I think they're going to pivot to all these companies, these $10 and $20 stocks that are much easier to push up. And AST Space Mobile actually has a pretty significant short interest. And that's like a moth to a flame. Have you heard the joke about the moth? I can't tell, it's too long. But if you get a chance, look up Norm Macdonald and moth joke. He basically tells a joke for about 5 minutes before he gets to the punchline. It's pretty funny. But in any case, again, the millennials driving things. Tactical. Look what they're doing. They're tracking this stuff. Okay, who's short? In fact, I want to show you one more. This guy. I actually subscribed to this. I'm just going to rank this by short interest. And you start to see what they're getting interested in. The screen is built on two things: the highest short interest and then the mentions on Reddit. I paid $5 for this. I was like, okay, I got to see this. That's how they're doing it. So you go mentions today, Smile Direct Club. No idea what that is. No idea. Is that Invisalign? I'm not really sure. Look at the mentions, the change. Smile Direct Club is Invisalign. Okay, so it's up 15% today on a down day. Look at all these stocks that they pushed up on a big down day. On track. Nobody mentioned it today, but it did go up. I think this was yesterday actually. Let's see. Did on track go up today? No, it's down 50 cents. So this must have been yesterday. In any case, it's amazing to me what they're doing. So in the face of this correction, you need to think about, okay, if the millennials are starting to bet against things, why are they doing it? Because they know, one, they're ahead of the boomers who are stubbornly holding on, and a lot of people who are stubbornly holding on. And they also probably know, they know, the hedge funds are going to pile on afterwards, or as it goes, right? Momentum. If they can create downward momentum, we'll get more people to jump on. And then Reddit will light up with, hey, buy puts on SPY, buy puts on this, buy puts on that. Let's kill the zombies. So be careful out there. That's why I don't want you in this stupid index. This has a long way to come down. All kinds of targets I have in here. You ever see when somebody shoots at a target, or you ever shot at a target? Try to get all your BBs or bullets into a really small place. That's it. And then I'll show you another trick. So back when I was an economics student, they said, if you draw something on a chart and it's not quite right, or you need to cover, a wider range of potential outcomes, what do you do? Make your dot bigger. That's courtesy of Professor Holloman. All right, a couple more stocks, and I'll take some questions. Ford, right? Now it's in our buy zone. It gets all the way down in here. I mean, it gets through here. There's an opening here, and then it could get down into the 9s. If Ford gets under 10, you ought to load up. You back up the truck. Because just like I told you a year and a half ago what they were going to say, I'm going to tell you what they're going to say next. What Ford is going to say next is that they are capable of going 100% hybrid and EV globally by 2030. And they might even say 2027. That's already what they're saying for Europe. When that happens, when they make the full commitment to dump fossil fuels and more people drive the Ford Lightning or the Mustang Mach-E, or the guys who actually do work with their pickup trucks, the 250s and 350 hybrids, they're going to crush GM. And they're going to take market share from everybody, even Tesla. That's how good I think Ford is doing in that March. Jim Farley has been very measured, not as aggressive as I'd like him to be. But again, I'm a self-interested investor. I bought this down here. I actually was buying it. No, that's right. Right here. Right? We were buying it at 5 and 6. This is where I went to CES. Then it started to come down. I buy this, buy this, buy this. So, basically a triple. And now we're getting a chance to buy it in here somewhere. Again, it's for all the new folks. When I was talking about this with the older subscribers a year and a half ago after I went to CES, I said, look, this Mustang Mach-E is going to be a Model Y or Model Y killer. Mustang Mach-E is a nicer car than the Model Y, I'm telling you. Drive them both. Sit in them both. I don't know for the wonk, for the nerd, if they're going to prefer the Mustang. but I think everybody else will. When these tax credits come through, that levelizes the playing field a bit for cars produced in the United States anyway. There's not going to be hardly any argument left for importing a car to the U.S. Almost none. Ford's going to make a lot of money selling EVs and hybrids for the next decade. So does it get below this spot right here? Does it get below 1160? I don't know. We might have to, I would probably sell puts there because I already have a position. In fact, I have a couple orders getting ready to go, as mentioned in the article. But if you don't own it, probably should put a limit order in at about, maybe even 12 for like a 0.5%, just to start that position if you don't have it. Barrick Gold was up today. That was nice to see. I'm getting my head handed to me on this one. I've round tripped it now. Yeah, round tripped it. Bought it. Should have sold it. Didn't. It's back where I started. The round trip. If you don't own Barrick Gold, the argument there is that gold is still valuable. It's not going to come down in price. And these companies are monumentally profitable at this point because they went through a multi-year retrenching to make these companies more efficient. So in Barrick's case, they have 10 years of inventory to mine without really having to start any more new projects. If you've seen, for the last 3 years, their CapEx has remained level while their compound annual growth rate's gone up about 20%. It's like 19.2. So that's almost, right? As far as industry goes, that's about as scalable as you get. They're not only paying out a dividend, but they have 3 special distributions this year. One is done and one just is about to happen. Maybe 2 are done and the last one's about to happen. So the dividend that you see on the screen is about half of what they actually paid out this year. Because the other thing they don't really call a dividend, it's actually a return of principal. So it's very tax advantaged. And I suspect they did that to appease certain shareholders because most of us have it in an IRA, right? But if you don't own Barrick Gold, this is a way to get into Canada with one of their best companies, with something that is a little less correlated to the S&P 500. It pays a dividend, and I think is either going to dramatically increase that dividend in the next couple of years or start to buy back shares. The other company to take a look at is Newmont. And the reason we don't own Newmont right now is because it's correlated to the S&P 500 because it's a component. So when the S&P 500 stops falling, that's when you buy Newmont. And it's getting close to our buy zone. You know, back here, when I made this chart, you know, people were like, what do you mean it's going to get back down to close to 50? You know, when it was in the 60s. You know, it's happening. It was really difficult to figure out where this one's going to. If it gets close to 40, you really want to buy a lot of it because the S&P 500, which is a component of, as people start to buy after a correction, there'll just be free money going into the stock, just like a lot of S&P 500 stocks. And you can see that it, you know, it can more than double. I'm not in love with this stock. It doesn't fall into my asset-light model, just like Barrick doesn't. But I give them a little bit of an exception because in an age where inflation maybe lasts just a little longer than I think, and where resources are a little bit more constrained because of supply chains, and maybe cryptocurrency gets beat up by regulation. Like I said, I think Ethereum, Bitcoin, and a few others survive and are useful. But the other zillion, trillion, quadrillion, Brazilian cryptocurrencies out there are going to zero. And that money will find a home. A lot of it will just go into Bitcoin and Ethereum. And I think Ethereum is going to be where people plump up their positions because the NFTs are a thing. We'll see. But if you are an older investor and you want some gold stocks, Newmont and Barrick, those are the only 2 you need. You can buy GDX if you don't want to pick stocks, because those are about half GDX and Barrick anyway, I think. They're big positions. Another stock that was up just a little bit today here on therapeutics, right? The substitute for opioids. Looks like it might have double bottomed. We'll see if there's one more leg down. There might be. There might be one more leg down on this. If it gets down to that 5-6 range, probably back up the truck. But this, this could be another Purdue sort of thing. I mean, this could scream. I mean, I could see this stock being hundreds of dollars. I really could. Because they're getting more and more usages, right, for their oxycodone substitutes. I think ultimately, oxy is going to be almost off the market in 2, 3, 4, 5 years. It's just such a dangerous narcotic. I think the whole movement away from narcotics is going to gain steam, and companies like this are going to do really well. There's one other company out there that doesn't have quite as good of efficacy, but they were a little ahead of them to the market. And these guys have been taking their market share. And I know a couple of doctors who are pretty shrewd dudes who have poured money into this. So everything I read makes sense to me. And granted, I'm a little limited in my scientific abilities here. Back in the day I studied science, but it's been a long time, 30 years since college. But the potential market size, I just think the potential market size, the company that the product that they're going to be replacing paid billions just in fines. Think about that. It's a gigantic market. So this is one where I think you should be selling some puts or taking a starter or both. And I'm not saying jump out and do it right now on any of these things, but you need to be really aware. And we'll see how this correction plays out. We'll see if the millennials push it even further down. We might get some Armageddon prices to buy. If this one gets into that 6-ish range, oh my gosh. Yeah, I mean, I'm almost never 100% invested. Almost never. Only after big corrections, and the last one I didn't get fully invested because I didn't know what was going to happen. This time I do know what's going to happen. After this correction, we're going to lick our wounds. I don't think the Fed's going to be quite as rescue driven, but at some point within 2 to 4 years, you see a screaming sustained bull market because everybody in government knows, and they're just trying to figure out ways to get the population to understand it. At least 51, 52% of the population understand it. That building a sustainable world is actually going to generate piles and piles of wealth. And one of the things in a sustainable world is you want fewer drug addicts. Pretty simple to understand. An open door, interestingly, was up today. So if you got shares of Open Door called away on Friday, like I did, it looks like this area in here that I said was the bottom appears to be. So selling puts, $17, $16 puts on any dips, probably a good idea. And I think you could even sell $18 or $20 puts in the money, possibly, if you really want to get it and you just want the extra time value on your option. But I think if you don't have a starter position here, find a spot to get a starter position, because the amount of money that these guys can make in real estate services is very Zillow-esque. Compared to Zillow, I mean, this is a better version of Zillow as far as I'm concerned, even though they don't have the app yet. Can I get more Zillow? Okay, let's just look at Zillow. There, that's Zillow. From a couple bucks. Oh, sorry. A couple bucks, $20 to 160. And I think the worst it'll get to is about 60. So a triple in 5 years. And I think that there's a lot more upside because, like Kazoo and Carvana, switching of big ticket items, incorporate internet sales and logistics, right? Delivery is a big deal. So this is Carvana, which is the American version of Kazoo. Kazoo had a little hopium off the start. and now it's trailed back down here. Kazoo is up 77 cents today. That doesn't look right. Oh, that's for the month. There we go. 1 day. There we go. Kazoo. Sploosh on what? What happened here? What's with a SPAC? What is that? What does that move from? Talk about Friday. Redemption. Redemption. Bargain hunters that know what's going on. And now it's establishing its range again. Probably going to break out. If you read the reports from Kazoo, they're expanding really fast. Really fast. So keep that in mind. Somebody asks, yeah, Kazoo just bought another company. Somebody asks, is the digital dollar going to kill the crypto craze? And I say no. I think it will kill the speculation in the altcoins that nobody uses. But the digital dollar, they're not going to do what I think they should do. I haven't read anybody saying that they should compete with Bitcoin. They're going to digitize the dollar just to have to get rid of wire transfers and certain interbank and other types of transaction fees. But I don't believe that any of us will have an account with the Federal Reserve. That'll be restricted to corporations and governments and rich enough people that can, throw $1 billion at them. So I think that the winners in Bitcoin, the winners in crypto are going to be Bitcoin, Ethereum, and like I said, a couple of others, because they do different things. They're got to remember there's a fixed amount, almost a fixed amount of Bitcoin and Ethereum and everything else. The digital dollar is still going to be tied to the Federal Reserve as far as I can tell, which means that it'll still be subject to printing. So Bitcoin will be a store of value. Ethereum will be for digital contracts. There is some reason to think that Ethereum will also serve as a store of value. We'll see. But they do print a little bit more of that than they do Bitcoin. That's different schedules. Tom asks about Lockheed Martin. Why did I pick 300-ish? Just look at this chart. I mean, I don't think you're in horrible condition. The daily chart doesn't matter. He asked about the daily chart. It doesn't matter. At this point, if you're a trader, it matters. You're not a trader. So you want to take a look at the weekly charts and the monthly charts. And yeah, it's almost oversold. Almost. And the monthly, again, almost oversold, but not quite. When you take a look at this chart, I mean, this is one of the best companies in the world. The kids just aren't interested. So when I take a look at this, this scares me because this and this are lower lows, which tells me this is probably going to set a lower low. And what I worry about is that it goes below this point. I don't think it does. So I'm probably going to buy in this area right here, around 300-ish, 310. But again, I don't think there's a ton of upside here. I mean, the upside that I was talking about with this company, because I was talking about this company back in the middle last decade, it might have happened. Just when you break down this company, you just start asking yourself, okay, I can see where there's a floor in here, right? You get these buyers are going to move up to here a little bit because the buyers always move up a little bit unless they disappear. If they disappear, then oh boy. And could it get down into the upper 200s? Yeah, I think it could. Then I ask myself, what is the real upside here? And I just don't know. I think, one of the things I've said about companies a number of times is that certain companies you're just better off working for than buying their stock. So unless I can get Bitcoin cheaper than the top orange line, right? If I can't get it at the bottom orange line, I might not want it. And again, when I say 300-ish, I mean, yeah, I could for sure get down to 280-ish. And if there's something really bad happening, this level right here, going back to 2015-16, somewhere in here is not far-fetched, low 200s. Now, do I think that's going to happen? No. I just don't like the way this looks for the last 3 years. What is sexy about this? we'd have to believe that it's going to go way up here. While that would be my price target, if I believe it 100%, I guess my level of conviction is just not as high. So I want to get it really cheap, close to 300, since I think that the upside is only 600. There's your double. Right on a dividend stock, that's my minimum is a double. Plus, we get 15% in dividends over 5-6 years. It's all about how much you can make, right? And as a dividend investor, you should just be interested with the margin of safety. At what point is it pretty much done going down with very little downside? Even if it chops around, I'd be okay collecting the dividend. But not if it drops down $60 or $70 on you. So I have Shooter's article up. Somebody asks about SPY puts. So over at Fundamental Trends, you got Shooter talking about different ways to trade here. And he's been mentioning some puts and different ideas. I don't even actually follow it that closely. For me, my hedge as a retail guy, because I don't have people that are paying me explicitly to short, I'm good at it. I'm just not great at it. I've made 2 trading mistakes on shorting stuff in the last 5-6 years. And for me, it's a lot of mistakes. I'm looking at a career where I just don't have mistakes like that. So it is not in my perfect wheelhouse to short the market, because that calls for not only accuracy, but precision. Because when you short, you've got a very limited time window that you have to get that trade correct. Otherwise, your puts go to nothing, or if you're using margin, you get a margin call. So for the vast majority of people who are not experienced with margin or shorting, you shouldn't do it very often. And usually there's an asset that will go up that doesn't require you to be short the market. In other words, find something that you can be long that'll go up when everything else goes down. That's where Stock Rover comes in handy, because you can take a look at correlations. It's like the cheapest tool out there for doing that. So no, I am not buying puts on SPY because I've already accumulated cash and I can make a whole bunch of money doing that. If you wanted to try to catch lightning in a bottle, you could buy some puts, but they're not cheap. Really, the only way I think to make a lot of money as a short is with futures, which means learning margin and being even better at technical trading. So if you're not experienced with futures and you don't want to use margin and you're not a great technical trader, I would keep your put buying to a minimum and don't use it as a way of generating wealth. Only use it as a way to offset the losses on the long side of your portfolio, right? Use puts as a way of getting more market neutral, not as a way of speculating on an outright decline by being short the market, because that's really dangerous and it can be really expensive. If anybody lost on those oil trades with me 2 years ago, you'll understand exactly what I'm saying. I have no idea which markets in China and Hong Kong are going down right now. I saw something on Twitter. Apparently, Kyle Bass was on CNBC today, taking credit for calling the China collapse. Markets in mainland China, Japan, and South Korea were closed. There you go. That's why Hong Kong got beat up. So probably China gets beat up tomorrow. So let's finish with EMQQ. Somebody asked about this stuff. Okay, so let's start with the monthly chart. Not oversold yet, and not even down to its lows. So it's got a ways to go, either down here or at least around here, right? But it's almost at that first target, 49. Shooter pointed out like $47.58. I've been saying $47.96 is where it starts to get attractive, and right, that's where the target is. So different analysis, him and I. We both said basically the same thing. And does he have it on here or not? No, he just put it in the chat today. Take a look at the weekly chart, right? Just got a little rebound. Now it's coming down again. So we might be 4 or 5 weeks from a bottom here, sometime give or take a month. I think that's pretty interesting, right? We're closing in on a shot to buy EMQQ, which is where you can get some commie stocks without 100% of the risk of the commie stocks, right? Because this is a bigger basket than that. And ultimately, China's got to make money, and they've got to be attractive enough for the developed world to come in. But I really do think Evergrande, which we talked about, I don't know, 2, 3, 4 times now. We talked about on Friday, which is why I'll try to find a way to save that video. Man, if I can get EMQQ around 40, which is, and incidentally, my limit orders on EMQQ, depending on the account, are at 40 and 42. So I think it's going to break through here. I might hit it, bounce, and then come down, but we'll see. We'll see how bad things get. I think it would be interesting if Chairman Powell wasn't as dovish as everybody wants him to be in a couple days, and he allowed this market to keep coming down. And then, as he is apt to do and showed a couple of years ago, just change his mind and go be super dove again. Remember, like almost a year and a half ago, so at the end of 2018, he was, it was all about tapering, and suddenly he changed directions at the start of 2019, or about interest rates. I forget exactly what it was, but he'll manipulate the market. If he can get this market down 10 or 20% and find a reason to taper less, well, the nightmare scenario that I'm seeing is if Manchin and the senator from Arizona block the stimulus and Powell just keeps printing money left and right. That would be a recipe for stagflation that I've been warning about, that I said 4 years ago they had set the table for. I don't know that it's going to happen, but I know that they've been pushing us in that direction for a long time, because the monetary policy flows mostly to investors, and fiscal policy flows to everybody. So this whole wealth effect, right? This whole inequality that we're seeing, this wealth inequality, at some point we have to fix it. And we'll either fix it because we're going to do the smart thing and reduce monetary policy and increase fiscal policy, which is the proposal, or we're going to do a weird form of austerity with money printing that's going to cause the investors to have everything and everybody else to get very angry. And the snapback on something like that will be epically bad. I don't think it's going to happen, but we need to be aware of what could happen. If we just keep printing money without building things, we got a problem, because people need jobs. We have to keep the world from burning up. And frankly, at this point, who doesn't want to work from home more often? Maybe not every day, but who wouldn't mind getting rid of a day or two of commute? You already got a quarter of the population working from home most of the time. Unless you're building something, doing something with your hands, right? Unless you're a skilled person, almost every office job out there can be done from home at least part of the time. That's a huge part of the economy. So I could see the economy being a third remote, a third hybrid, and a third on-site in the next 5 years, maybe 10. Again, we'll see, but let's be aware of the bad things that could happen if we get bad policy. And unfortunately, we get bad policy from time to time. All right, have a great night. I'll have more tomorrow. Let's see what's going on. I'm not sure if we'll get the snapback tomorrow or if we'll get the snapback down the road. But remember, the calls and the puts expire weekly. So I think we're going to start seeing week-to-week cycles for a while. Maybe through the end of the year. We'll see. All right, take care.